Welcome to our channel. My name is O'Brien and I would like to thank you for watching this video. If you find value in it, please like and subscribe. And if you have any questions, please put it in the comment area below. Thanks again for watching. Let's now jump into how to understand and use the option chain. When you open up a platform, one of the major platforms like Thinkorswim, E-Trade, or TastyWorks that we're looking at right now, you'll be able to put in a symbol. We have put in the S&P 500 or the SPY, which is the S&P 500 ETF index. And when you put in that symbol, the option chain is going to come up and it'll look similar to what you see here. You have the dates, the day of expiration is listed out, the day of expiration here. And that is corresponding to how many days to expiration, which is going to be down this vertical area here, as you can see. So you can have something that's expiring today, you can have something that's expiring tomorrow, or you can have something that's expiring years from now. So if we break this down and we go down here, you can see that this is expiring in 887 days to go. When you are looking at the option chain, usually to the right of the date of expiration, you're going to have something that might have a W. That just means it's a weekly option. You might have it expiring weekly. It's a weekly expiration period. You might have something that is a Q. That just means it's a quarterly option. And if you do not have a weekly or quarterly, then that's usually going to be the main expiration period. As you can see here, that's the third Friday of each month. So the main expiration period for options is the third Friday of each month. That's where you're going to have your most liquidity. And that's also going to be usually where a quarterly option expires. A weekly option can expire on a Friday. It can also expire on a Monday or a Wednesday, something such as that. It all depends with a weekly option. All right, so once you decide, you can decide which expiration period you're going to choose. And usually we talk about doing something that is primarily between 30 and 60 days. Sometime the Dorian Way, we talk about doing something that's long dated, something over 100 days. Then sometime we'll do something short term, even the same day type of option. All right, so let's jump into this 47 days, the expiration period, and let's break down the option chain a little bit more. All right, so when you open up an option chain, you're going to have the date of expiration to the left. That's usually universal on the major platforms, broker platforms that we talked about. And that's the case here on this TastyWorks one. Then down the middle here, you're going to usually have that date to expiration again. So this is 47 days we're looking at. All right, and then to the left, you're usually going to have calls. Calls are usually always going to be on the left-hand side over in this area. And then on the right-hand side is always going to be puts. And this is the right-hand side here. So calls to the left, puts to the right. Then this strike area, these are strikes. These are called standardized strikes. They're standardized because the exchanges set these strikes. The exchanges like the New York Stock Exchange or the NASDAQ Stock Exchange, and they're standardized because everyone can see them. And only time these strikes will change is if they're adding to them. They will not remove them within this 47-day period. They could remove a strike after this 47-day period expires, but not in between the expiration period. Okay, they will only add to them if required. All right, so when you're looking at this option chain, you want to understand which direction is going up and which direction is going down. So on your screen here, going up on your screen is actually going down on an option chain. So for example, we have 435, 434, 433, 432, and so forth. This is actually going down on an option chain, which is going up on your screen. And then vice versa, going down on your screen is actually going up. You have the 436, 437, 438, 439, and so forth. This is actually going up on an option chain. So it's important to understand that. It's a little confusing initially for beginners and even some people who have been around for a second,
But if you build yourself a solid foundation, you'll come to understand that this is pretty brilliant how they set this up, and then you'll really understand why they have done it this way. All right, so once again, when you're looking at options, calls are to the left. When you're dealing with these options on an option chain, calls are to the left and puts are to the right. And that can be the case on any option chain. Once again, I'm just going to show you this Thinkorswim one. You have the calls to the left here, and you have the puts to the right. So it looks a little different, but it's pretty much the same. You just have to understand. If you understand one option chain, you should be able to understand them all. And it's important too. So these are the strikes area. These are the standardized strikes on the Thinkorswim platform here. All right, so let's jump back to this TastyWorks one, and that's continue. You have the calls to the left, puts to the right, and then this horizontal line right here, this is the at the money line. Okay, this is where the stock or the underlying is currently trading. It's called the ATM. And where it's currently trading is the SPY is currently trading about $435.52. That's right here. And then that area is somewhere in here. Okay, somewhere here. This is the at the money area. Okay. And on the left-hand side, on the call side, above the at the money line, this is considered the in the money area, the ITM. And below it, it's considered the out of the money area, the OTM. It's very important to understand this. The put side is the opposite. Usually when you're dealing with a call or a put, if one thing is bullish or one thing is bearish, the other is going to be the opposite. So in this case, on this option chain, the opposite is over here on the put side, on the right hand side is out of the money, the OTM. And then this is the in the money area, the ITM. So it's very important to understand what is at the money, what is in the money, and what is out of the money when you're dealing with an option chain, because it's going to determine if you're going to be assigned some type of option. Are you going to be required to provide some options or some shares? Are you going to have a high probability or a low probability of winning? That's all determined by at the money, in the money, or out of the money. All right, so let's jump over to this Thinkorswim platform so that you can see how that looks as well, just to make sure you understand. Once again, this is the at the money area where the shaded areas kind of separate. This is at the money area on the Thinkorswim platform, and it's pretty much the same. This is the area here. This is the last price that they have. And then once again, this is the call side. This is the put side. So this shaded area here is the in the money area on the call side. And then this is the out of the money area on the call side. And then it's the opposite once again on the put side. All right, so it's pretty much the same. If you understand it, then if you understand one option chain, you should understand them all. All right, so let's jump back over to TastyWorks one and let's break this down some more. So on an option chain, it's also important to understand what the ask and the bid are. And it's on both sides of an option chain, the ask and the bid. All right, so the ask is where you can buy at. And usually on the major option platforms, when you buy, it's going to be green. That's going to be associated with buying. Okay? In this case, if you're clicking on the ask down this column here, then you are buying. You're buying on an option chain. When you are clicking on the bid, that's when you are selling. And so, and selling is going to almost 100% of the time represent the color red when you're on the major platforms. Right? And when you're selling, you're in the bid area. This is the bid area here. You're clicking on the bid area. And once again, that's the same on both sides. Okay, that's the same on both sides. So you do have a mid area between the bid and the ask. That is this number in between here. That's the bid and ask. So if you click on the ask here, a single option, this is not a spread. A spread is anything more than one option leg can be considered a spread, so two or more. In this case, you have, when you click on the ask, it's giving you like the market price, and then you can have the mid, as you can see down here, the mid price, is a little less. So when you're buying something, it's better to buy it for cheaper. So instead of buying it for full 653 here, we can actually buy it for 651 if we can get filled at the mid price. That is the price between the bid and the ask. That's the mid. Most of the time when you're trading with options, if not 100% of the time, you want to be filled at worst case scenario at the mid or something very close to the mid. All right, so let's continue on. Another thing you want to understand on an options chain is just the open interest, and that's set up on both sides as well. Open interest just means how many options are still open that haven't been closed out at a certain strike price. So once again, right here, this is a strike price that's 430. On the call side, which is the left-hand side, you have the open interest. It just says this is 38 options that are open at this time, and then on the put side, you have 86 options that are open. So this can be thousands, it can be 30s, it can be zeros, as you can see. So for example, if we go over here and we click this 40 days, the expiration period, and we look at the 430, then you have over 18,000 open at that 430 strike. You have over 17,000 open on the put side at that 430 strike. So it all depends what the expiration period is and so forth. But everything we teach you to trade at the Dorian Way, it's all going to be a lot of liquidity in it. Even if your open interest says 0, that doesn't mean you can't get in and out of it. All right, so we're just going to go back to this 47, and just to kind of break it down here, you can see that you have some, just to be clear, you have some 0 open interest here on this call side. On this SPY is the most traded, the most liquidity, that has the most liquidity for an ETF in the world, and you can see that on this expiration period it has 0 open interest. So it does not mean it's not easy to trade, you can't get in and out of. It's just the circumstances for this strike price at this time. All right, so let's continue. On an option chain, you also have the delta, and that's on both sides. And you usually want to have your option chain set up with delta or something that's probability in the money. On our Thinkorswim platform, if we go to this option chain here, we have it set up as probability in money here. This is our delta on this Thinkorswim platform. It's the same thing for the most part. So if you're using delta, you stick with delta. If you're using probability in the money, you stick with probability in the money, and your probabilities will play out accordingly. All right, so let's jump back over to this TastyWorks platform, and we put delta on, or probability in money, on both sides on an option chain, because delta is one of the 4 major option Greeks, and delta is the most important option Greek because delta measures 2 things. Delta measures your directional risk and your probability of success. As for directional risk, delta measures how much you will make or lose based on a 1-point move. So for example, if you had 100 shares of SPY, you have 100 shares of this SPY, and each share equals 1 delta. So you have 100 shares, so that equals 100 deltas. And delta measures how much you will make or lose based on a 1-point move. So if you had 100 deltas or 100 shares and it went up plus $1, then that means you will make $100 because you're going to make $1 per share. If it went down $1, then that means you would lose $100 or $1 per share. So your directional risk is down if you bought shares, if you were bullish on shares, if you were positive on a company and it went and you wanted to go up, then your directional risk is down. That's what you fear. If you sold short some shares or a company because you were negative on it, then your directional risk is up. You do not want it to go up. Delta measures how much you will make or lose based on a 1-point move. So you can also think of delta as how much the option is going to move. So for example, if we look at this 30 delta here, this means that this option is going to move 30 cents for every $1 move in the SPY. So it's either going to go up 30 cents or it's going to go down 30 cents. So if you had a 50 delta, that means it's going to move 50 cents for every dollar move. You can actually have an option that moves just like stock, that is 1 for 1, that has a dollar, it has a dollar expiration period. So let's look over here and let's see how you can see that it wasn't showing on that 47-day one. But if we go here and go up to the at the money here, keep going down this way on the call side, you'll be able to see that you're going to have a 1 delta. So this is a 1 or 100, meaning it's moving just like stock. It's moving. So every time this SPY moves up $1, this option is going to move up $1. Every time it moves down $1, this option is going to move down $1. All right, so let's jump back over to this 47-day expiration period. So that's the important part to understand about directional move. It's also something called beta weighted delta, and that kind of measures a basket of something and makes it equivalent to one thing. So for example, if you had, let's say, 5 different underlinings on, or 5 different stocks on, and you had something that was a consumer staple, you had a tech company, you have a bank, you had all different stocks, 5 different ones, and you had 100 shares in each one. So it wouldn't equal 500 shares, because that's not the truth, because you wouldn't have 500 deltas or 500 delta directional risk, because those 5 different sectors that you have will trade differently for the most part. Sometimes they might all go down, sometimes they might all go up, but they're going to do that by a different percentage level. But you want to be able to know what all of those look like if they were just one thing, if they were equivalent to one thing. And most of the time, professionals, they beta weight their portfolio to the S&P 500. So we're looking at the SPY here to just say you beta weighted your portfolio to the SPY for example purposes, and you had 5 different stocks. So you would beta weight it and make it equivalent to how many shares you would have in SPY based on these 5 different companies you have. So when you beta weight it, it might say you have 25 positive deltas in the SPY or these 5 different shares. So what that would mean is that every time the SPY went up $1, then you would basically make $25. And every time it went down $1, you would basically lose $25. So it can kind of give you an indication of how your portfolio would act based on the broad market, the S&P 500. Right? So that's a basic understanding of beta weighted, how you beta weight your portfolio to a certain index. All right, so we also talked about that delta measures your probability of success. That's the second thing that delta measures, and it's really important to understand that, right? Obviously, it's super important to understand your directional risk, and then it's super important to understand your probability of success. So if you are buying something or selling something at the money, and this is the at the money line once again, the ATM, then you basically have a 50-50 shot of making money. You have a coin flipping chance of making money, making at least 1 cent at expiration, not losing money, not breaking even, but at least making 1 cent. You might make more than that, but for understanding purposes, right now we're talking about making at least 1 cent. So having a 50-50 shot is not bad, right? It's better than having something less than the 50-50 shot. You at least have a coin flipping chance to make money if you're buying and selling something at the money. But buying and selling something out of the money, and then that's where the probabilities change, and they change dramatically for the option seller. So this is the out of the money area again. Once again, that's for the put side. This is for the call side. Okay. So let's break this down and let's talk about this. If you were the buyer of this 30 delta, then you have a 30% chance of making at least 1 cent at expiration. And you have a 30% chance of making at least 1 cent at expiration if you bought this for 423 strike price. Now, once again, on this option chain, this is the days to expiration. And I want you to understand that option probabilities are based on expiration. Options are the only product that can kind of predict what's going to happen, right? And it can predict what's going to happen based on all the buying and selling of the calls and the puts within an expiration period. And from all that buying and selling, an implied volatility is created. And this is what you can usually see on the major indexes, okay? The major brokerage firms. You can be able to see the implied volatility. So this is the implied volatility for the SPY right now. So it's important to understand that. And from that implied volatility, an expected move is created. This is the expected move. This plus or minus 15, almost 16 there. Let's just say it's 15. It's closer. Let's just say it's 16 because it's closer to 16. And on the TastyWorks platform, it kind of gives you the expected move within this ruler. Anything that's landing inside this orange ruler here, that is within the expected move. Outside of the orange ruler, that means it's outside of the expected move, that it's bigger than what the options are predicting within this expiration period, okay? And that expected move is determined by the implied volatility that you can see on the option table, on the option chain here. And it's, if you want to understand that, just think about the implied volatility. If it was 100%, then that would mean that this SPY had the chance to go to zero or double within the next 47 days. Okay, so this is obviously doesn't have a chance to do that because the implied volatility is only a little over 17%. But that's how you can understand implied volatility if you were trading something that's a lot more volatile. All right, so once again, if you're buying something at the 30 delta, you have a 30% chance of making at least 1 cent at expiration. The probabilities are based on expiration. It's not based on before or after. If you're talking about before expiration, then delta talks about how much delta talks about not the probability of success, but also the probability of touch. So this is a 30 delta. If you're talking about before expiration, then it's a 60% chance of probability of touch, because probability of touch is 2 times delta. So within this time frame, it's a 60% chance it's going to touch this 423 strike. But the probabilities of winning at expiration is only a 30% chance. If you hold this to expiration, it's only a 30% chance. So it's important to understand the difference. It's somewhat subtle, but it's a major difference to understanding your success of winning, okay? If you hold something to the expiration, almost all the time, your probability is going to be less than not holding it to expiration. So in the Dorian Way, we teach you how to not hold things to expiration. So you can have a higher probability of success. In addition to that, we teach you how to be the seller, how to sell the option, because if you sold this same 30 delta by clicking on the bid once again, that's when you are the seller. Then instead of having a 30% chance of making at least 1 cent in expiration, you have a 70% chance. It's the inverse. We talked about earlier, usually if the call is bullish or bearish, then the put is the opposite, and vice versa. So in this case, it's another type of inverse. If you have a buyer at out of the money 30 delta, then the seller is actually a 70% chance of winning. So even though it's the 423 strike price, even though it's the same expiration period of 47 days expiration, and the implied volatility is the same, the expected move is the same, the seller still has a higher probability. I'd rather have a 70% chance of winning than a 30% chance of winning. The reason why it's a difference is because the seller acts like the insurance company. The seller receives almost 100% of the time what they can make up front. Right? So the most they can make usually is what they receive up front. So if you pay Geico $1,000, that's usually what they can make off you, not including the deductible, within the term period of the contract that you have with them. And so you would have to have an accident that costs more than what you paid them for Geico to lose. So if you pay Geico once again $1,000, you got in an accident and the accident was $900, well, Geico still won off you because they collected $1,000, so they still get to keep $100. So that makes the probabilities on their side. All the criteria that they come up with, and they decide to charge you that $1,000, but puts the probability on their side. And that's what we try to do. That's what we try to teach in the Dorian Way, is teaching members how to have criteria when they place a trade, because that's when you're the only time you're on offense. That's the time when you can control everything. You can control your probability. You can control how far you're from out the money. You control how much dollar amount you receive. You can control how much you're receiving on return on capital. All these different type of factors you can control when you are initiating a trade. And so selling something at a 30 delta gives you a 70% chance of winning at expiration. Once again, this is about expiration. Okay, so just to clarify this even more, or illustrate this even more, if you are the buyer of this, and we just turned this about green, so you're the buyer, then you need a big move to happen before you win at expiration. Okay, you need a big move to happen. The SPY, in this case, on the put side, would have to go down quite a bit before you win. And if you are the seller, then you need to have a big move to happen before you lose. All right. So that's, once again, another subtle difference, but a huge difference, because the buyer needs a big move to happen before they win. The seller needs a big move to happen before they lose. I always want something to happen in a big way before I can lose something, right? That would make your odds a lot greater on everything you do. And that's how we trade, trading options, the Dorian Way. All right, so that's delta, and it's super important to understand on an option chain. So we talked about the in the money, out of money, out of the money. We talked about the bid and ask, the open interest, delta, and we talked about the expected move, the implied volatility, and things like that. And that's all on the same, and that's on every platform that specializes in option trading. You can see that on the Thinkorswim platform, this is the implied volatility here, and this is the expected move here. They could be different on different platforms, so you just have to, whichever platform you're trading on, that's where you keep your standard at. Sometimes they use some different math, but it's all pretty much a Black-Scholes type of formula, or a small deviation from the Black-Scholes type of formula, to be able to determine what is the implied volatility and the expected move of options when in an expiration period. So once again, we were looking at the 47 days, the expiration period, with this SPY. So that concludes our video on how to understand and use the options chain. If you found value in the video, please like and subscribe to our channel. You can also go to our website and look under events to be able to register to some of our free webinars that we give almost every week, or some of our in-person events that we do all across the country. Once again, thank you for watching this video. We'll see you in the next one.